Hi everyone, Josh Horn, Horn Valuation and Tax. This last video is about the allocation of enterprise versus personal goodwill. I'm going to keep this one pretty quick. I just want to introduce the concept, and this, hopefully, if you watched the other two videos, is third in the series. First was the bucket video, where I explained the concept of goodwill and how important that is in the context of business valuation, divorce, and litigation. The second video was an on-screen demonstration of the importance of valuing a company using multiple approaches, if at all possible, so that you can understand how much goodwill you have and why using an asset approach to value a company only can result in significantly undervaluing the company and valuing the empty bucket, as we discussed. So this is the third video, and just recall that we looked at a financial statement. I just want to show you real quickly and just refresh your memory. We talked about quantifying an estimate of the goodwill of this business at $135,000. So we used the balance sheet to come up with an estimate of the value. And as we discussed, there's a high likelihood that this business, using only the single asset approach, was significantly undervalued because the other two approaches weren't used, which were the income approach and the market approach, which valued the business at $555,000, resulting in a difference of $135,000, which represented the goodwill. Okay, so just recapping that issue. I should also point out that there's another problem potentially with using the asset approach only in any kind of a business valuation setting, in that it could violate what's known as the premise of value. So in addition to many other things we have to take a look at when we start out valuing a company, one of the most important things we have to nail down early in the process is to discuss the premise of value. And what that means is the premise, the expectation that the business will, I'll give you a couple of examples, will continue as a going concern or would be liquidated. A lot of times in litigation environments and divorce environments, the expectation is that the business will continue on. So a going concern premise is used. Well, by definition, an asset approach is liquidation. So you've potentially violated the premise of value right out of the gate. So keep that in mind if you're looking at valuing a business. This could come up. And let's talk about the factors in business goodwill. And it's typically could be split into two different components. That is the enterprise goodwill, which is there as a result of the efforts, if you will, of the collective business, cannot be attributed to one individual, and then the personal goodwill. So in other words, taking this one step further, you could be in a situation where you would be asked or would need to take the $135,000 of goodwill and allocate it between a business component, that is the enterprise component, and the personal component. Now, what does that mean exactly? Well, the easiest example I can come up with to give you to sort of get this in your mind would be a dental practice or an accounting practice or a law practice or maybe a massage company. You're dealing one-on-one with an individual, exclusively almost. And to the extent that that individual is directly responsible for the success of the business, that goodwill could be attributed as personal. Possibly, depending on judgment. Now, what are some of the factors that go into this? Let's bring these up on the screen. Personal goodwill factors: the expertise, skill, and reputation of the individual, the personal abilities of the individual, the credentials, licenses, and experience, the customer confidence in the individual's abilities, personal relationships with the customers, the nature of the services provided, the individual's direct impact on business profits. Now, I want to make sure that you think about this globally, though, because this can come up in any kind of a business. Now, historically, professional practices and things similar to that have been the ones that have been looked at for personal goodwill issues. However, could a construction company have personal goodwill? Of course. Yes, it could, definitely. You could have an owner that could be responsible for bringing all the sales in, dealing with the customers. You'd have a manufacturing company, the same kind of thing, where it's very capital intensive, but there could still be a lot of goodwill associated with the person. And this could be extremely important in a divorce or litigation environment, especially when the personal goodwill is not a marital asset, not subject to division under the case law or the statutes. Very important. So just real quickly, one way to consider splitting the personal enterprise goodwill, splitting those into two parts, would be to analyze the business with and without the individual and come up with a difference, in essence. I'm not going to go through a detailed example here. I think you get the point for the most part, I hope. If not, email me, call me. If I didn't do a good job, let me know. This is 3 in a part 3 series of videos on goodwill and divorce and litigation and business valuation. I've had a lot of fun with this. It can be a complicated topic. That's why I broke it down into 3 parts. And if you're still struggling with it, particularly if you're not an accountant, which this isn't really designed for accountants, they understand this stuff. If you're not an accountant by trade, let me know where you're struggling with this, because it is, conceptually, it's difficult, especially if you don't have an accounting background. I understand. Josh Horn, CPA. I've had a lot of fun with this. Have a great day. Take care. Bye-bye.